Hi, I'm Martin McGrahy from Financial Edge Group, and today I want to take you through my top 3 tips to make sure that the volatility in the share market doesn't affect your retirement. My first tip is understand what your super is invested in. A lot of people just look at these statements and don't look at it or don't have an advisor looking after for them, but it's important to sit down and make sure you understand what your super is invested in. How much have you got in Australian shares and what type of shares it's invested in? How much you have overseas and what type of companies are those invested in? You've got some allocation of property or cash or bonds or fixed interest. The more you understand something, the more you know what's going on, the more confidence you're going to have in what your super is doing. I'm a big believer in what you measure, you can manage. So rather than just seeing the headlines of the markets are down and billions of dollars have been lost, that doesn't mean that directly affects your portfolio, because you might be invested very differently to what the news headlines are talking about. Your quality of your companies could be a lot different to those that are down, because some companies are down but not all. So it's important to understand exactly what your super is invested in. My next advice is always have a cash buffer. Have a cash buffer at any stage in your life, but particularly in retirement. What that means is you've got money sitting in either outside of super and ideally inside of super, that's the cash that you're going to live off. You're not exposed in having to sell money out of the share market every single week or month to fund your retirement living. You've got a cash buffer that you can live off for a period of time. Different people have a risk certainty of how much time they want to have in that cash buffer, and that's a personal thing that I can talk to you about, but always have that cash buffer in there. What that means is you can live off for say 6 months or 12 months or 2 years or 5 years of cash without having to be affected by the share market. What that means is it doesn't matter if it's down this month or up next month for your retirement, because you've got that cash sitting there. Therefore, by the time you need to touch those shares in a period of time, it'll be enough time for those to recover. So that's tip number 2, always have a cash buffer. Tip number 3 is focus on the income of your portfolio. At the end of the day, the income is what we can spend, it's what we want to live off. And we want to make sure we're invested to get that best income. If you had a lot of your money in cash, on top of your cash buffer, the income return you're going to get at the moment is going to be fairly low, because interest rates are so poor. We need to have exposure to shares and other assets going to give us a high level of income. Even though those values may fluctuate, we want that income coming in on a regular basis to fund our living expenses. So ideally they're topping up your cash buffer, as we talked about before. So tips are understand what it's invested in, have your cash buffer to ensure you can ride out that volatility, not having to sell when the market's down. And 3, focus on the income that's coming in, because ideally that's what we're going to live off. Hopefully that's helped. That's a tip that I take through all my clients to understand the volatility and make sure it doesn't affect their retirement.